as a large growth stage fund, want to give liquidity for two reasons. One, I want to give angel investors and other VCs that are smaller than me an ability to show returns to the people that gave them initial capital. Because if they didn't invest in these companies in early stages, I wouldn't have any deal flow. The second one is, as you grow bigger as a fund, it's much harder to get the ownership that you need. And it's an easy way for you to be able to buy out other companies and get all the ownership that you need in a company, right?
Hey, Tito. Thanks for being here. I truly appreciate it.
Hey, Louis, how are you doing, man? Good to be here and speaking.
Yeah, no, amazing. Let's dive straight into it. Currently, you're the principal at Partech, as you said, and you're responsible for all the Nigeria activities. How did you have to change the way you invest from pre-seed to now growth stage investing?
So principal at Partech, I'm not in charge of Nigeria. Technically, we don't have regional focus in Partech. And so I just live in Nigeria per se, but I invest across the continent. And you were saying, how did I have to change I think it's really interesting shifting from an early stage mindset to a later stage mindset. I think being in investment banking and trying to sell to private equities at the start of my career made me understand what end state looks like. But then at early stage, what you have to unlearn is all the blockers, because there are a lot of things that you have to just frame in your mind and say, look, it's risky, but I'm going to bet on the market and a founder, and I'm going to bet on upside, right? And as you grow higher up in the stack, you have to be more less tolerant and be like, I want to see sustainable growth. I want to see you've hit an inflection point, because I think there's go to product, go to scale, go to product, go to market, and go to scale, right? So go to product is creation of the product. Go to market being, I've now found my market and I want to, get product market fit. And then finally there's go to scale, which is everything's good and I want to pour fuel on the fire. So what you look at kind of changes at those three stages, basically.
No, absolutely. When you come in now, what stage is that typically at? And what are the, let's say, metrics or key criteria that you apply to pass or invest?
So Partech, we do $5 to $10 million tickets. So I would say that's probably sitting between a Series A and a Series C, depending on the round size. And the typical things that I would ask is what you said. I mean, it's a bit relative, right? So I think my key filters for every deal start with the market, the founder, and the operations, right? So in my breath, I think the first thing you have to think about is this market big enough, and can you scale significantly venture-wise in that market, right? So you want to play markets that have the propensity for venture scale growth, because that's what we're trying to do. And then with the founders, it's like, are they obsessed and do they have the ability to execute? Right? Because I think people that will get bored shouldn't be investable in the long term. And I like to say we date in VC before we get married. So you meet a founder, you're dating, then you get married, and it could be 10, it could be 15 years, right? So they have to be super obsessed to still stay on that track, but they also have to be able to execute in terms of having either prior knowledge or readiness and speed to learn and hiring, that kind of thing. And then the final one, I think, is the operations, right? Because some, I would say, verticals are inherently not VC. So you have to think about how much capital do you need? How much is it CAPEX intensive? Is there regulatory, I would say, blockers that make it not scalable? And I think those are kind of the lenses I usually use. And the first thing that I would ask a founder to be able to kind of bucket companies into different parts.
No, absolutely. I just want to double down on the market aspect. Now with AI disrupting businesses and technology globally and also more and more in Africa, how do you think about emerging markets that are not really that easy? Like you can't really size them that easily. You know what I mean? Where they're maybe nascent and there's a great founder, but the market is maybe not that big yet.
So I guess there's two things, right? There's a question about AI and that market not being there yet. I like to call AI in Africa, we're at the stage of African intelligence as opposed to artificial intelligence. I think the gap in Africa is a data gap. So we unlock more data from these, I would say, repositories with telcos and banks, and we get more consumer data. We'll start to see, the data gap closing. And I would say it will offer significant opportunities in the long run. So I think it's a more data gap on the AI side. And you can see that in a lot of different markets, right? Where you see that, for example, cybersecurity in Africa is still on the earlier side because there's not that volume of data that is precious enough and not that volume of value that's precious enough in our digital ecosystems yet for people to be willing to pay such outsized amounts of money like you would in the US to keep that data and value, right? But eventually we're going to grow to that, right? So I think there are these markets, and I'm not set up to invest in those markets because I'm a growth stage investor, right? So I'm thinking of investing in growth stage. So like I said, go to scale, like already product market fit, and I'm fueling a fire, right? But the seed investors are. So and when I was earlier in my career, I had to look forward and as to what does this look like in 10 years, right? So today I'd be doing a deal in cybersecurity because hopefully in 10 years it's there. Or today I could be doing a deal in AI because hopefully in 10 years it's there. And you see that some people now are investing in like GPUs and the actual infrastructure thereof of AI on the continent. And some people can be investing in the actual data gathering piece, right? How to build, I would say, authentic IP in data to be able to create, train LLMs to actually go from African intelligence, like I like to call it, to artificial intelligence.
Yeah, no, absolutely. Fully agree on that point. On the note of markets and sectors, with the deal flow that you're seeing right now and how you're thinking about making investments maybe throughout this year, what sectors do you find most promising right now?
Oof. So it's not an easy question. I think I'm at the moment very B2B focused in the sense of like products. I think inherently there's going to be two stages of the African consumer. The first stage is where the typical business in Africa is going to basically, if you look at the metrics, right? The demographic savings, TPV, like, so how much they're transacting is almost similar to an average German, for example, right? So an SME in Africa is basically a German, the middle class German. So when you're creating products for them is where you're going to see the kind of inflection points that you would see in Europe for a middle class consumer. And that's, I think, where products are focused now. So solving their pain points around financing, I would say finance their FinOps and operations, solving their pain points around how they send money around, right? So if they're trying to do cross-border payments or just to pay their suppliers, pay suppliers in, for example, China, Dubai, etc. So I see cross-border as definitely one of the levers for Africa in the next couple of years. I think cross-border payments more than remittances, if I can put it that way. I think remittances, there's not a lot of modes, but cross-border, there's a bit of relationship. Still no crazy modes, but I think still relevant in huge markets. I think B2B banking isn't being done well for the bottom of the pyramid. And so there's something to serve in there for sure. I think in fast moving consumer goods, I think there's a space to play for luxury items. Now, luxury items I would also class as maybe beauty and tech around that. I think a liter of Coke costs way less than a liter of body lotion, for example. So even if you earn 5 to 10%, that value turns into much more cash. And I'm yet to see someone actually break into that market and do stuff. And yeah, I think naturally wrapping AI onto and inserting AI into the typical things that we do are going to be important also in the long run. And finally, I think the biggest driver for growth as a sector in Africa will be energy. And I think more and more energy becomes important because it's directly linked to GDP. So for me, just closing out, I would say there is the most room for growth and impact investing in energy. The problem is the CAPEX piece to it. And it's really how do we scale energy investing or energy tech and climate tech on the continent without necessarily in an asset light way, if I can put it that way.
Yeah, no, absolutely. 2 points that I want to touch on there. First, you mentioned moats. What are competitive advantages that you must see in a business to invest? What's like a non-negotiable for you that has to be present?
I think the competitive advantage, I'll say two really funny competitive advantages that people don't really would traditionally not say. The first one is really the founding team, right? Like you have to have an unfair advantage to be building in the market you're building in, right? Like if you are a ballet dancer trying to build a television, I don't see what advantage you have. And I think that's the first competitive mode that people don't look at properly, because what exactly is the founder bringing to the table that's different from everybody else that would be building the same thing in that market, right? And it's not a traditional competitive mode as you would think about it, but it's really what sets aside people that are all the same, building in the same market. Those are one of the things. And the second one is also non-conventional in terms of competitive modes. I'm saying the non-conventional ones first before the conventional ones. The non-conventional one is it's not a competitive mode per se. It's kind of we're all on in a big ocean. Is the larger the market, the less the need for a competitive mode is. So to go back to my cross-border payments, and why I like it is because I think eventually, we'll be honest with ourselves, the barrier to entry is pretty much, if I have technology, I can move money, right? So it then becomes, you have to have speed to market. You have to have inherent operational efficiencies that make you so different. But the market is so huge that there's going to be so many players, right? So it's not a competitive mode per se, is I can make bets earlier on markets that are massive and then build out modes. Now, the real modes, I would say, that we really will see on the continent are businesses where operational efficiencies require you to build out some kind of infrastructure. And that's why I think technology is great, but there's always this balance between touch and tech to really deliver real value in Africa, because by nature of the market, there is a lack of infrastructure. There's an infrastructure gap, right? So there's infrastructure you will build that will make you important and become a competitive mode. And I think, secondly, on the fintech side, we're always looking at regulation. So people that are super regulatory first, people that are super talkative with the regulator, they have their licensing, they're always compliant. I think eventually what will happen is that because we're figuring things out, there'll be a lot of cowboys. But as the convergence in knowledge between the regulator and the fintechs or the disruptors starts to, converge, you're going to have to be regulated, and they're going to care about it way more. And that's going to be one of the most important modes. And then I think a fourth mode is, especially on the B2B side, is trying to deliver value or to sign exclusivity in a way that just switching costs are too high.
Mhm.
And I think that ties into operational excellence and a little bit of that. But yeah, I think that those are the real modes, right? I think outside of that, I struggle to think of what else can be a real mode, right? Outside of execution and founder ability, operational excellence, exclusivity and regulation. Apart from digging an actual, I don't know, a trough and thing and pouring water in it as an actual moat, I can't think of anything much more that you could do.
I see. Thinking of the founders, and every investor, every VC always looks at the team and the founder quality. And when you look at the really successful cases in Africa, at least, they're most of the times either second-time founders or executives that are maybe in their 30s, started the business, have a couple of years of industry experience, and saw the inside of the industry and then disrupted. Do you feel like local first-time founders, let's say like a Nigerian that wants to build a fintech, are inherently disadvantaged?
No, I think the beauty of this is people ask this question about founders and don't stress enough about founding teams, right? I think there are gaps in, let's put it like this, right? A founding team needs to have operational depth and an ability to execute operationally, technical depth if you're in VC tech, because you need to create technical products that, make you more efficient and you can leverage or give your customer. And then leadership and vision, right? Which kind of speaks to the long-term vision, which speaks to hiring talent and bringing the entire team together, and the storytelling that helps you be able to fundraise, right? And I think you, at any given point, want to have at least, some people at the early stage, you will have only one, but you want to have two of these. Three would be the holy grail, but you want to have two of these, know that there's a gap and try and hire for the remaining. But I think being a second-time founder is not an assurance of anything. Going to Harvard is not an assurance of anything. Being from the same industry is not an assurance of anything, really. They give you an advantage, right, that you can leverage. But a second-time founder with no operational depth, that was like the head of sales, might not deliver. That is for me, the holy trinity is finding founding teams. I mean, you can either find founding teams or find a founder, but finding one person that can do all of this is much harder. But finding founding teams that have great operational depth and excellence, strong technical ability to be able to build technology products for within and for without, to give to customers, but also to iterate within. And finally, the leadership and visionary skills to be able to put all of that together, raise funds, raise a team, lead that team forward. And I think that's what I think are the best traits in a founder. Now, the nuances of sector, I would say knowledge, or I've already built before, or all of those things, you can still throw those advantages into the hand of a team that doesn't have these things, and they will not be successful. Because the DNA of what makes them successful is really this, for me, most times at least.
No, absolutely. And touching on something you said earlier with the energy and unlocking energy investment, how would that look without using a lot of CAPEX? What are the models that you're seeing on the ground that are interesting to you? Because I'm just wondering, if you build solar, you have to buy the panels, right? Which is CAPEX intensive, for example. What are the models that you're seeing that don't have that?
I'm going to name drop a portfolio company here, a company called Beacon Power Services. So what they do is that they optimize the grid by providing software to distribution companies and utilities across Africa. What fundamentally they're doing is they're going to a distribution company, let's say the Electricity Company of Ghana or Echo Disco in Nigeria. I'm mapping your equipment, I'm mapping your customers. I'm first of all giving you a geospatial representation of your network, right? Doing that alone, you find old equipment, you find customers that aren't on the grid already and paying. You find people that aren't metered, you find spot meters, right? That alone increases revenues energy-wise for those utilities, right? And then you can layer on the actual energy reconciliation, which is all those meters, letting them speak to each other by smart metering. So you can tell where the electrons are shooting to, who's getting electricity, how much electricity, what's on, what's off. That is maintenance that you can't do with analog systems. That also increases efficiency. And then once you increase that efficiency, you can layer other things on, right? That costs a fraction of what it would cost to basically, I would say, electrify 1,000 people. Because all I have to do is go map them, make sure that they get electricity, I collect more from them, and then the utility can invest more, right? So all I need is really manpower and technology, right? So basically, if I have an agent network and technology, and actually sometimes you don't even have to pay for the agent network because the utility has people that will do it for you, right? So it's just they're not doing it in an efficient way. They're not doing it tech leveraged. They're not collating the data properly, right? And so there's that, right? So just optimizing what we have. 70% of the electricity on the continent still comes from the grid anyway, right? So optimizing the grid is more of a driver than just putting solar panels everywhere, right? So you have to optimize the base because that's the heart, right? Now, on actual deployment of mini grid solutions, I think it's very hard for me to say, I want to invest in a company that's going to deploy solar. What I can do is go out and say, can I invest in a company that wants to fund solar marketplaces? So a solar financier. So as a technology company, I want to be able to understand and deliver on financing to a broad base of solar markets places and solar companies across the continent. I build the tech to understand what they're building, integrate to their API so I know how efficient they're being. I know where all their customers are. I can collect all my money using technology. I'm a financier, so I'm basically going to large debt funds or pools of capital and creating deals that are Africa focused in the sense that African, I would say OEMs or African installers can pay back these debt deals and they're not overpriced. And my job is to come sell them in the markets, right? So I'm one step removed in that I'm not doing the CAPEX myself. I'm just funding someone to do the CAPEX, but I'm complete technology leverage so I can work on doing several projects at the same time and funding them. I've made that up, but I'm just saying that could be a way, right? I don't know any company doing that today, but I mean, maybe one or two trying, but yeah, think of it as a solar debt fund, for example, case in point.
No, absolutely. Speaking of that, venture debt, Partech obviously always publishes the annual Partech report. And last year, share of that was pretty high. I think also surprisingly high. And most of the funding growth, let's say, was debt driven. What do you read into this, or what does that tell you about the state of the ecosystem?
So my personal reading on debt, and I've said this since I started my career, is debt is I would say, a signal of a maturing ecosystem, right? It's an ecosystem that understands sustainable returns and understands the cost of equity. I think a lot of growth has been funded by equity that didn't need to be funded by equity and could have been done non-dilutively through debt. So it says that founders understand that, you can scale through debt, but it also says that debt understands the VC asset class. So both are meeting each other, right? Because traditionally, a debt provider would be like, what? Early stage tech company? I'm not giving you any money. Now you can see that they will give you money, which is the ecosystem maturing. And you're seeing the founders are creating capital structures that do include debt. So for me, it's a very positive signal of our ecosystem's maturity and drive for sustainable returns. And finally, I think you're going to see a few more venture debt funds in the close future, or either venture debt strictly, or maybe hybrid funds that do both equity and debt, because you're able to then give some returns in the short term whilst waiting for that maximum output return in the long term.
No, absolutely. I spoke to Monica from Rand Merchant Bank, the head of private capital, yesterday, and she raises capital for all the funds. And she also told me that even now, like she knows of 5 new venture debt funds that are going to launch. So
Exactly.
that's definitely a trend that's gonna continue. And how do you, because you're obviously based in Nigeria, you have offices in Senegal, but you're Pan-African. How do you think about sourcing deals across the continent, but also allocating capital across the continent? What markets do you personally find most compelling and interesting?
So on sourcing deals, it's one of those things. So we have offices in Lagos, Nairobi, and Dakar. So we have pretty good coverage of those markets. And we're always in Cairo and always in Joburg and Cape Town to source deals from those markets. Those are the big 5 covered, right? I think from a technology point of view. Now, to really source in the other markets, you build relationships, really. Abidjan is pretty good. We have relationships there. We go there quite a bit. But then to source from the newer, I would say the markets like Cameroon are just coming out with a couple of cool companies that have been doing quite well. Ghana has a few standouts too. Tunisia has a few standouts. And Morocco has been revolutionized since COVID in terms of how much the king has pushed the tech ecosystem there. It will never rival the big 5 in terms of just pure volume because population and size, but it's been really interesting to see Morocco grow. So our deal sourcing is done mostly by flying down, done some online on LinkedIn and the like, but I would say mostly by flying down, creating relationships with investors, with ecosystem players, with other founders, and just getting that quality deal flow from them. And honestly, from the Partech Africa report as well, people do reach out to us because we have this piece of thought leadership. We have this piece of thought leadership that attracts people to us. And it's a good way for us to build relationships and source. Yeah. And from an allocation of capital point of view, I think we are not biased. It is really who is it building for what and can we deploy? We'll deploy. I don't think there's any bias there.
Absolutely. One thing I also am super curious about, because as a growth stage investor, contrary to early stage investors, you have the luxury of, in theory, also buying secondaries and buying positions through that.
Yeah.
Can you explain, just also for the audience, for context, what are secondaries and why are they important or becoming more important?
No, 100%. So I think secondaries, in summary, if you want to understand how investing works, either I can give you a primary in cash, which goes into investing in operations, technology, and the like in your business, or I can do a secondary where I buy out existing investors on your cap table. Why secondaries are interesting for founders is you give the cap table the ability to get liquidity, and yourself, by the way, ability to get liquidity on all the value you've put into the company. It's non-dilutive in the sense that because it's not primary, you're not creating new shares, so you don't dilute the present cap table. And most times secondaries are done a little bit discounted to the primary to show that people leaving are not going to get the full value of the upside for staying, right? Because if you think about it, if I'm going to get off of the bus and I'm not going to put any more value, I shouldn't be getting the same price as people that are coming in and about to put value in to be then invested in the company, right? So that's kind of the intuition around it, right? So that's what secondaries are in summary. And I think with funds like us and other large funds, liquidity is important in ecosystems. I call it the circle of VC life, right? I, as a large growth stage fund, want to give liquidity for 2 reasons. One, I want to give angel investors and other VCs that are smaller than me an ability to show returns to the people that gave them initial capital. Because if they didn't invest in these companies in early stages, I wouldn't have any deal flow, right? So one, it's a deal flow situation where I need to create the deal flow by giving these guys capital. The second one is, as you grow bigger as a fund, it's much harder to get the ownership that you need. And it's an easy way for you to be able to buy out other companies and get all the ownership that you need in a company, right? So let's say I had an ownership target of like 15% of a company. What I could then say is, look, I can get only about 7 to 8% through a primary investment. And then the rest of it I could get by buying 5% of the cap table or whatever the case may be, 5 to 8% of the cap table through secondaries, right? And everybody is winning and it's an alignment of interests. So that's really what we play. And the role we're playing more and more is to give that liquidity to the ecosystem because it's important for the story in Africa.
No, absolutely. And that recycled capital as well that goes then into new deals that you then can invest at a later stage, right?
Exactly.
And speaking of liquidity, it's good that you give liquidity to the early funds, but you obviously at some stage also need liquidity. How do you think about liquidity in your own fund, especially because you come in at a later stage from Series A to C. Yeah, how do you think about that?
No, 100%. I think on the liquidity question, right? I think I always like to frame this with African exits will always be a function of time. So ecosystems that started before us, like Brazil and India, after their first 2 decades, they started seeing a bit more liquidity and some even longer than that, right? I think we're a bit more nascent, so we're a couple of years behind them, at least a decade behind some of these markets. And you want to not rush the liquidity story is the first thing I'll caveat with. However, we do need liquidity. And most of the funds are coming up to their 10th year. Well, I would say most of them are maybe in their 6th or 7th year. And then the older ones are maybe 10 years old. And, you want to start showing that liquidity in the ecosystem. We've already had one of our first exit with SendWave, which we completely deployed back into Wave, which is now one of the largest mobile money protocols on the continent. It's not that we don't think that liquidity is important, it's that we also think that it's a double down that needs to be done in the ecosystem into different verticals. So there's this balance between taking your money off the table, but also knowing that there's a lot of upside. And I think how that's going to be solved is funds like us raising larger funds to be able to buy people out. And with the private equity players coming into the market that have deeper pockets to buy us out. And as capital markets mature, I think you're going to see I am of the personal opinion that a lot of our IPOs and liquidity events have to happen here on continent or close to our continent as possible. So let's say Egyptian companies in Saudi. I think it's very hard to reconcile an African company if you sat in New York as a Goldman Sachs trader, right? So you're going to get a little bit more liquidity on local stock markets. But I think fundamentally, strategics and private equities are going to play the liquidity game for us on the continent.
Okay. So you're also very, very strict with profitability then when you already come in, and then also as the business progresses in its life, because otherwise private equity is not really a potential buyer, right?
No, that's a really good point. So when I come in, less strict, line of sight to profitability, very much so. And I think it goes down to the fundamental way the market is set up in Africa, right? There are markets where because of the infrastructure, the holisticness and the predictability, you can afford to make less money for a much longer time. Case in point, if you look at the macroeconomic outlook of Japan and the United States and most of Europe for the last decade or 2 decades, it is not as volatile for sure as Africa, but also there is some predictability that even when it went out of whack, like save COVID, because COVID has messed up everything. But when it went out of whack, some people could say, oh, maybe we would have seen that coming, right? And some people actually bet on the financial crisis and the housing crisis, you know what I mean? So in the sense that like in our markets, it is so unpredictable in 2 to 3 year sprints that you have to be profitable because the infrastructure doesn't back you not being profitable, right? And that is before you jump into the question of private equity. So this is how you must create these companies in the first place. And that's why, because private equities in the States could do and would do non-profitable companies because they have a clear line of sight to how the infrastructure will work in 5 years. Here, not the case.
Yeah. No, I mean, if there's less certainty in a way, then investors are typically willing to take less risk as well, right? Which then
Exactly.
manifests in having to be profitable and having free cash flow and reliable
Exactly
cash
that.
flows as well.
No, yeah, exactly that.
On the IPO topic, because I mean, I agree. I think if so, then local listing, and you're obviously there also have to be profitable. Otherwise, public market investors won't touch you. Do you think that will happen way more often? Because like last year, Optoza went public, Cash Plus went public. Do you think we're gonna see a wave or like multiple companies going public throughout this year, next year, or where's your head at as it relates to that?
The first question is who deserves to, right?
Yeah.
I mean, we can't go from we can't go from the answer to the question, right? So it's who deserves to go public. Because if you are a company that's valued at, I don't know, a paper value of $1 billion, but you're making a loss of $5 million a year, and you're only doing revenues of $25 million or $30 million a year, but then you had a massive VC come in, I would argue you're not IPO ready, right? So why you're not having an IPO isn't a function of, well, the IPOs aren't happening. It's because you just raised a large valuation and you're not IPO ready, right? Like, so I guess let's not go from the answer to the question is my first caveat there. The second caveat is a lot of companies aren't set up. Sorry, a lot of capital markets aren't set up to IPO companies, right? Like in the tech ecosystem. And the final one is a lot of things are overpriced. There's a mismatch between what capital markets can pay compared to what these companies are valued at. And that mismatch is because fundamentally, okay, so if non-local people price a local asset, it is less likely for them to price it in the right way. And that's just how the cookie crumbles, right? So if you're telling me that no Nigerian bank is worth a certain market cap, but then a Nigerian fintech is worth more than the top 2 banks or 3 banks combined, then there's a disconnect there. Because what the capital markets is paying is seasoned investors that know the country super well, paying for an asset in the financial ecosystem. Now, a company that's only made money in Nigeria that does one thing in the financial ecosystem, be it that is hockey stick and whatever the case may be, and we can say all our jargons, right? How can you possibly be worth more? If you're playing in a subset of that ecosystem, how can you possibly be worth more? The only way you can be possibly worth more is if you want to own a lot of a company. So that's the misalignment, right? You're worth more because you want to own 70% at exit. You're not worth more because the value you're creating is worth more. Does that make sense?
Yeah, no, absolutely. I mean, you kind of countered the counter argument already. The counter argument that like growth stage investors or in general VCs would give you is if the growth is there and the revenue projections align, then there's an argument because you pay forward. But yeah, I get what you're saying completely.
Yeah. No, I think it's just a function of how capital is raised, who was involved in raising the capital with you. I used to angel invest. I've seen cap tables evolve and people take money from the wrong places, and that eventually stagnates growth. But in the short term, it's really good for growth because you get nice capital. In the long term, you can't ever raise again.
Yeah, no, I get it. I get it. Just because you mentioned it, you also don't have to answer if you don't want to. For SendWave, you said the exit they got sold, I think, for 500 million, right? And you rotated that money from that fund into Wave. What was the decision behind that? Obviously, investing in Wave was brilliant and the right decision. But what was the decision of not giving the LPs liquidity there and distributing versus reinvesting that directly?
It was reasonably early in the fund lifetime when that happened, and was betting on the same founding team. The founders themselves had skin in the game in Wave, more so than us, actually. They invested more than us in Wave of their own money from the proceeds of SendWave. So that's super conviction of people that built something that was over $500,000, sold it, and decided this is a bigger problem that I'm going to double down on. They don't need to tell you where to drop your cash. You drop it there. I mean, the question is, do we make this early distribution, or do we double down with these guys who are doubling down more than us, right? Like both in their time, their value, and their cash, right? So it was a no-brainer for us.
Yeah, 100% conviction right there. And on the angel investing side, how do you evaluate those businesses or that companies to invest? Do you approach it differently than your, let's say, day job at Partech?
I'll be very honest with you. Earlier in my career, at Echo VC, we used to see seed deals and sometimes some pre-seed deals. It was really early. It's easy to get that pipeline. As I've scaled in my career, it's much harder to get that pipeline. I'll be very honest, right? Like, so I'm doing a lot less of those angel investing deals, and I'm doing more like the few people that come through my door. I would, do a bit of advisory, kind of introduce them to the launch Africas, the future Africas, the what they call now endeavors of the world, the tech stars of the world, so they can kind of like start that journey. Right? And just kind of more directive than angel investing nowadays. But I will say this about angel investing, that evaluating those deals always came from a place of market and founder. That's what you're doing at the start. Is this thing big enough? Is it exciting enough? And is the right person to back? And you kind of just pray for the best. And I think the angel investing, and I would say the seed funds and pre-seed funds are the backbone of every single VC ecosystem, because they're the ones that kind of plant all these little flags, right? So you go plant all these little seedlings, and then you have the incubators and accelerators who are like kind of the tillers and the farmers that kind of water these seedlings. But these guys that go out and get and pick up these like $1 million funds and do these K bets everywhere are really the guys. Because as much as incubators and accelerators are great and super important, I think they also have the way the interests are aligned is I get paid to do as many good or bad people as possible, and hopefully most of them turn out good. So regardless, I'm getting paid. With VCs, with the seed funds and angels, you only get paid if it works, right? So there's only one way to get upside, right? And I think they're the backbone. I think we need more local paper, local capital doing angel and seed investing. I think that's the only way to price right at the start. And I think that's a lot of conviction also comes from seeing local people that understand the market, backing people early. A lot of our LPs need to be local. So a lot of the capital from limited partners needs to come from local. We need to have more pension funds that are local involved, more family offices involved, so we can price deals properly. We can fight off inflated capital. Because for me as Partech, the end goal is I don't want to have to not do a deal because it was overpriced by someone that knows nothing about the market. And that's what sometimes happens to us at growth stage, right? I'd rather know that there was a surplus of local capital, at least getting companies to Series A or Series B, right? And also, if you have local capital funds, if you look in like South Africa, for example, there's capital being deployed in Rand, so they don't mind a devaluation or not. The exposure is in Rand, right? And that's big. There's big family offices involvement in South Africa. And then Egypt is kind of catching up now. You can find a few big family offices there. But I'll say Western and East Africa, we're still a few far behind in terms of that. Everyone is still doing real estate and, and like, I don't know, like everyone has more land instead of investing in like OPay or MoniePoint or something, you know what I mean? And I wish they would, because there's returns value.
No, absolutely. I think that's also a good point to conclude on. I think I learned a lot. It was a really good conversation. Thanks for taking the time. Truly appreciate it.
No, thanks, Louis. I think, yeah, we need more of these conversations and honest opinions out there about the ecosystem.
Absolutely. If people want to reach out, let's say they are already at Series A and they're looking for an investor, where can they find you?
On LinkedIn, for one. And also, my email is tito@partechpartners.com. So feel free to send me an email with your deck, a little blurb, and we'll take it from there.
Perfect. I'll also link it in the show notes. So if there are any founders, please reach out.
Okay.
Amazing.
Thanks, man. Have a good day.